Hi guys, a very good morning to you all who've tuned in live to this broadcast here on Moneycontrol. The show is called Morning Trade with me, Stacy Pereira, and I'm here to help you navigate through all this volatility that we are seeing for the past couple of days. 6 straight days of losses there, big cuts coming in for the benchmark indices as well as the other ones. We're seeing big cuts on the bank Nifty. All other sectoral indices also traded in the red. If you looked at just yesterday's trade, a total of 17.77 lakh crores of market cap erosion is what we've seen in these past 6 days. So all of that is something that we're going to have to trade with or keep that in mind when we're going ahead and trading today. So we're going to be helping you with those stocks and strategies that you could be adapting to in order to get through these turmoil times, we could say, on the Lal Street. And more importantly, let's also answer those queries for you. So keep those coming in through the course of the show, and our guests will try and answer those for you. So our live stream is there. Please do send in what queries you'd like to have addressed by our guests. But before we get to all of that, let's take a look at what we're getting from our global handover. Now, stocks continue to sell off on Wall Street. The Nasdaq falls nearly 2%, sliding into correction territory, while the Dow Jones falls for the sixth session out of the last 7. Meanwhile, the U.S. economy has grown by about 4.9% in the third quarter. This is its highest in 2 years as consumer spending remains strong in spite of the higher interest rate as well as inflationary pressures, among other headwinds. Stocks in the Asia-Pacific market rebound after a heavy sell-off, while China's CSI 300 index has slipped after news of former Chinese Premier Li Qiang's death. Back home, the GIFT Nifty is signaling a muted but higher start for the Indian markets. And crude oil prices too have fallen. Brent crude trades around $88 a barrel as the outlook on demand remains unclear. Rising inventories in the US along with that also weighs in on prices. And Reliance Industries will be reporting its numbers post-market hours today. Steady growth is expected in the digital services as well as retail businesses, while a strong refining margin is expected to be offset by the weak petchem spread. And apart from Reliance, also watch out for earnings from pharma majors Dr. Reddy as well as Cipla, Maruti Suzuki, Bharat Petroleum, SBI Life as well as Bajaj Finserv from the Nifty 50 will be reporting their second quarter numbers today. Well, it seems like quite a difficult few days that we've seen. If just going by the last 6 days where we've seen huge carnage, just big cuts coming in there for all the benchmark indices, that it would be safe to say that Nifty is also now below that 19,000 crucial levels as of yesterday, down about 4% if you've to just seen last 1 week alone. Even hitting that 200 EMA or exponential moving average of about 18,830 in intraday trade yesterday. Now, this has happened for the first time since April. So we are going to look at this in detail about what the charts are really telling. Is there more correction expected? Because that's the one question that is on everyone's mind. Should they be playing the wait and watch game, or should they go ahead and, now because the markets have come down would be a good opportunity to enter? Well, let's discuss that and also what the charts are really telling. Joining me now is Raja Venkatraman, the co-founder of Neotrader. Good morning, Raja, and thanks so much for joining us here on Moneycontrol. Let me first get your sense on the levels that we're looking at the Nifty. Pretty much every day we're breaching a new lower levels. We've seen all of those support levels really come down. Yesterday, even going down below that 18,900 levels. So what are the charts now saying? Where could we look at support as well as resistance when it comes to the Nifty?
Yeah, good morning, and thank you for inviting me to the show. Now, when you're looking at the markets, currently the entire market is going through a larger turmoil than just the Nifty, Bank Nifty. And that is what is impacting the markets at the moment. Currently, we are caught in a global turmoil, and that is spiking up the macro and also impacting the global cues. So now, since India is a highly correlated economy, as far as India is concerned, we have been doing pretty well. But what is happening right now is the global cues are impacting our sentiment. Now, coming down to our indices, the indices have broken. If you talk about Nifty has broken 19,000. So, which is not a good sign at the current juncture, and that is something which needs to be taken cognizance of. And the entire circumstance, external environment is not supporting a recovery at the moment. So people will generally feel that yes, there is this Diwali sentiment which will come in. So there's a good dip to buy, and markets are going to revive. So these are some sentiments which will step in at this juncture. But my advice would be that wait and watch, because based on the time cycle signatures which I have studied, the next month also is going to be a very mixed month. After falling so sharply, the probability of a range bound action is more on the cards, and 19,300, which was a very important support for a while, will now act as a resistance. So now the overnight bounce which you are seeing right now on the gift Nifty would carry to an extent, but then overall the market is going to be pressured. So I would advise a sell on rally approach, or buy only for an intraday. Now, when you take a look at this scenario is largely triggered by Bank Nifty, where Bank Nifty is underperforming the Nifty, the mid cap index, the small cap index. So, Bank Nifty is the main villain out here. And as long as Bank Nifty does not show any recovery beyond 43,500, I don't think that it will be a easy task for the markets to recover. Now we need to wait for these things to settle down. So it is a wait and watch mode right now. So if you are on the trading side of the market, then it's a good time. But if you're on the investing side of the market, you have to be very, very selective, because the kind of reactions which you are getting to the Q2 numbers are not encouraging. So we'll have to wait it out for the next few days.
Right. So Raja is saying it is going to be a different strategy for traders, whereas different strategy for investors. And that's how we're going to be looking at this current market and the way it's been going on for the past couple of days at least. But let me also bring in Hemant Shah now. He's a fund manager at Seven Islands PMS to get a fundamental picture. Because if we go to see, India has quite, outshined its peers, we could say, compared to other global market, not just markets, but economies as a whole. Even now, if the markets are not doing so well, our high frequency indicators are quite telling, and they've been holding up in terms of the macros. So we do not have those kind of headwinds to be looking forward to, except for those external ones which are really changing the picture for us. But if you look at how markets are performing now, one particular pain point we would say is how FPIs have really reacted in all of this. We've seen them pulling out of equities right from September, where we saw about 1.78 billion worth of outflow in the month of September, whereas October now, with just a few days left, already 1.68 billion is come out from the FPI. So that, we can be blaming geopolitical figure, the whole tension around that, even crude oil prices that have been swinging. But what are the other kind of headwinds that could really impact the Indian economy, as well as then translating to the markets?
Thank you. Good morning, Stacy. Thank you for having me on your show. See, first of all, let me just put it in perspective. As you said, India is definitely the shining star today in terms of the growth and GDP, as well as the potential of the growth. So India can be the growth engine for the world. That is, there is a growing consensus, frankly. So yes, as of today, there are many headwinds, right from the interest rates, higher interest rates in the US, slowdown in the US and European economy. It's going to have a long, we have seen 600 days of war since Ukraine and Russia has erupted. So these were all known risks, right? And I personally feel known risks are not risks. But in the last 15, 16 days, the escalation between the Israel and the Palestinian, the conflict has converted to a war. This was a new negative again for the world economy and geopolitics, right? So that has been given as a reason for the market to fall, particularly in India. though macros are all stable, it has been digested by the Indian markets as well. Okay, the rising interest rates, yes, everybody knows it. Slowdown in the economy, yes, everybody knows it. The spending power of the US economy with respect to some specific sectors is definitely slowing down. Yes, we know it. But this is just the reason I would say for the market correction, Indian market correction specifically. And I would be happy to see this correction, frankly. And put it in perspective, India and in fact has seen the best 6 months, one of the best 6 months of rally. If you just see from 1st April till say 30th September or till maybe yesterday, right? We have started our index journey from say 3rd April at around 7,500 Nifty till 20,200 somewhere in the middle of September. And now we are 6.5–7% down. And exactly what we are down is just with respect to the world markets, right? So we have initially outperformed the world indices, and now we are in correction mode in tandem with the world indices. But yes, as you said, Indian economy is absolutely in the bright spot. I mean, we can vouch it with the GST numbers. We can vouch it with the GDP growth. One of the highest GDP growth in the world of such a large economy, right?
Right.
So,
in fact, Hemant, we've also seen the numbers coming out of the US. Yesterday, they had their Q3 GDP numbers out, and it's been highest in 2 years. So we are seeing even growth happen in the US, although the central banks, for that matter, are not really looking at that. They are still focusing on inflation, we could say that. And one factor that really changes much for us here in India is oil prices. Now, that we've been seeing quite a bit of swing, and that has not been enough to divert the attention from rising US bond yields. And that also, showing that bit of trickling down, we could say, to how people are reacting. If the bond yields are really going to be something that is going to shake the markets, or equities for that matter, at least in India, and how should one be, what is that impact that we're going to see because of rising US bond yields?
Yeah, so I think bond yields are peaking out. See, Stacy, our view at Seven Islands is very clear. The bond yields are peaking out, and there is only one way it can fall, but the fall is going to be not fast. It's going to take longer. So the higher interest rates are going to be there for some more time, and the deceleration of interest rates is going to be moderate. So that is the only way out, right? And I personally feel India will be unimpacted with rising bond yields. Even today, it has been unimpacted. Yes, you're right. With respect to oil, it makes a lot of sense for the India since we are the largest importer of oil. But in the last 6 months, if you see, the country has managed the import bill also quite well, with respect to importing from countries like Russia, increasing volumes from Russia or increasing volume from now Saudi. And India is now dictating terms to buy the, oil price at a reasonable discount to the current market price. I personally feel that is also taken care by India quite well, I would say. So in a nutshell, correction is welcome, and this is the good buying opportunity for long-term investor. But having said that, I think investors should right now, for the short term, avoid the industries which are dependent on US and European economy particularly, right? So PSU banks is the domestic center. So basically we are positive on domestic centric industries where India is spending, government infrastructure spending is at the highest, right? In terms of railways, in terms of Jal Jeevan Mission, you can say, in terms of Kusum, the policies are now being implemented. We have never seen this kind of excellent implementation by the government. So we are positive on domestic industry rather than the industries who are dependent on US.
Right. So Hemant, hold your thought there, because we are, of course, we're focusing on domestic industries and how that will work. So let me also bring in Raja now to ask him what are the sectors and even stocks perhaps that he's looking at especially at this time? Like, if you're looking at from a trader's perspective, is it now not a right time to be, short covering? What are the kind of positions one's supposed to be taking, in this juncture when we're seeing this much of correction in the markets? What would be the specific sectors? Like how Hemant mentioned, look at domestic ones. What would be your play at this point?
Yeah, very good question actually, because considering the way the market has given a broad-based correction, there is going to be possible opportunities emerging, especially in the area of capital goods and industrial manufacturing, because I feel that these two sectors are one of the primary sectors of Indian growth. And if we are expecting that the growth which India is showing is expected to continue, then these are the two sectors one should concentrate on. Yes, these two sectors have received some severe correction, but then I would be focusing on some revival in these two sectors in the coming months for some buying opportunity. There are some very good names out there, like I would say HAL is one, Bharat Forge is one, then the next sector would be auto. So capital goods, industrial manufacturing, and auto would be three sectors which I will be focusing on. And if you take the case of auto, we have got TVS Motors, we have got Tata Motors. So these are two stocks from this space which I would be tracking for some strong revival. So if the overall market stabilizes at this current juncture, and we see revival beyond, at least for a startup, it has to cross 19,100 comfortably by the end of the day. Then we can expect a target towards 19,300, and then the levels will move on. As far as Bank Nifty is concerned, I'm targeting 44,000 as immediate resistance. Yes, it does seem far away, but then that will be the minimum Bank Nifty will have to move, because Bank Nifty has never given us a promising section as yet. So Bank Nifty or related Bank Nifty stocks, heavy weighted stocks like say HDFC Bank, ICICI Bank, or Axis Bank, you can use them as a say a day or 2 day opportunity. But then the other sectors would be a good spot to consider from an investment perspective.
Right. So that should be the strategy. Both gentlemen do stay on with us. Let's address a couple of stocks that are going to be in focus today. We do have big earnings coming in. One of them definitely being Reliance Industries. Now we are looking, if you look at an estimate that we've put out by 10 different brokerages, they're looking at a consolidated net sales, which is expected at about 2.31 lakh rupees. It's just a minor increase, we could say marginal, by just about 0.5% on a YOY basis, much higher on a sequential basis though. Net profits is estimated at about 17,482 crore rupees. This is a good jump of about 27.2% if you look at the profits. If you look at EBITDA, now this on a consolidated basis is looking at the number of 39,696 crore, which would be a rough estimate of about 28% higher, whereas the retail business, now that is where we're going to see that offset, because there have been new additions in terms of stores, new acquisitions, that one really getting in a lot of foreign investment as well. So there in the retail front, the EBITDA is likely to increase because of that higher foot traffic as well as all of the M&A activity that has taken place. Whereas if you look at the telecom vertical, now Jio, there the EBITDA is likely to gain from all those new subscribers. So different verticals of Reliance Industries that will be in focus, but of course their overall growth is also looking positive at this point. Let me bring in Raja once again to get his sense of how one should be looking at Reliance. Of course, everyone looks forward to it, but in the last few days, given the sell-off that we're seeing, Reliance also being one of those which has really taken it on the chin. But these numbers could really change the game. At least what we are getting from estimates, they're looking quite positive at this point. So how is one to be looking at Reliance?
Yeah, so yes, right now, like you mentioned, these are estimates, and over the last few days, we have been seeing that even if a result is beating the estimate, the markets are not favoring it in a positive manner. So right now, what we have to consider is that the overall price action in Reliance since almost the last 4 months has been on the descent. Now, this descent could find some supports closer towards 2200. So, if there is a reaction and price dips down into the 2200 mark, then that could be a buying opportunity in Reliance, because the overall momentum is continuing to be weak. So I will not encourage buying in Reliance at the moment. I'll wait for the levels at around 2200 and then consider buying into Reliance.
Let's also get a couple of queries answered. We're getting a query from Chirag Tolasaraya, who's asking your view on IRM Energy. Now, this is a newly listed company, so we just put out its earnings as well. So, what is your view on IRM Energy?
So the overall, the way it has actually moved out, right? So we need to consider that the current market scenario is not favoring the new listing at the moment, and the overall prospects of any stock to sustain the steady upward bias is quite difficult. So now, if you're going to invest into this stock, I would at least wait for it to cross the listing high made at 485, which is the only way you will know that yes, there is a continued upward bias emerging here. Otherwise, it could be a IPO day high, and then we all know so many stories out there which have flashed a high on the IPO day, and then subsequently the road has been only downhill. So I would wait for the high to exceed, and then I would consider.
Right. Let me go back to Hemant Shah and get his view. Now, given the volatility we're seeing, the correction that we're seeing, would it be safe to say that, the mid-cap party is kind of almost dying out now, and one should be focusing on the large caps? Because when there is this much of a correction and all, those are the large caps are the one that you'd want to see on the forefront and could really change the game. So what would be your strategy when it comes to mid-cap versus large caps?
So good question, Stacy. So basically, yes, people are now talking about hiding again back to the large caps. Then once we have seen this mid cap tremendous rally, I mean almost 38% rally in last 6 months, and now the mid cap index is also corrected around 7.5-8% from the peak. Yes, but as you said, mid cap rally, I think per se broad rally is very, I think now played out quite well. But that doesn't mean that mid caps are not going to outperform in the future also. Right now at Seven Island, we have a mix of investment, a balanced investment of large cap as well as mid cap. And as you said, yes, ICICI Bank being a large cap, and you can just see the numbers. Amazing numbers. I mean, it definitely deserves an investment bet, whether it's large cap or small cap, doesn't make no problem at all. So ICICI Bank is amazing, but in mid cap now you have to be very choosy. That value, validation, and visibility are the three ingredients we ask ourselves before investing in mid caps now. And from now on, we'll have to be asking this question thrice: valuation, visibility, and validation before you invest in mid cap now. But yes, large caps are also a part of investing strategy for sure. But it's going to be a mix of large cap and mid cap again.
Right. So since we're talking about since we're talking about large caps, one of the stocks that I would like to focus on is Infosys. Now, it has been in the news for different reasons, and one of them being that just yesterday there was a $300 worth penalty that was imposed on Infosys' US branch, and this for the non-remittances of their past due. Now, this comes quite interestingly when you're already seeing IT stocks, not have such a good Q2 numbers that we've seen from most of them. Well, they've also gone on to add a new client where they've bagged a 5-year deal from an EV maker in Europe that's called GmbH, and this in order to transform their customer experience. Now, all of this is in news, and which is why you're also going to see some bit of action in Infosys. And while we're talking about Infosys, another very interesting news point or news headline that has come out of all of this is recently we heard Narayan Murthy, who's the co-founder there, saying that young IT workers should be working for 70 hours a week, and that will bring in a new new kind of work culture that is needed. Now, this topic has become quite a bit of a debate, especially on social media, because people are trying to understand where does that mindset really come with, and that will be a topic of a different discussion altogether on where, how much is the ideal working hours, at least for IT sector. But let's get an overview from Hemant on the IT sector, because this is again one that is very dependent on the US, and like you were pointing out, we should be focusing on the domestic manufacturing and those kind of sectors. But we've seen a lot of buyers coming in right now after those Q2 results for IT. So how should one be playing IT stocks at this point?
So as you said, yes, in the short term, as I said, I think IT has been absolutely neglected by almost everybody, and even the results are below expectations. I mean, by 1 bips or 1.5 bips, nothing much actually. But the size, I mean, it's a given that Indian IT sector has given India a place in the world market, right? So there is no doubt about that. So Infosys is a great company, unbelievable, managerial representative has, leaders has given by Infosys to India, particularly. So particularly specific to Infosys, I think we are positive, but very long term, I would say, Stacy, very long term. From the current price, to double the size of Infosys in the next 5 years, in terms of revenues, I mean, it's a tall task. It's very difficult when you are dependent on a countries and which are on the verge of recession and slowing down. The order flow is stable but not growing fast. I think we are positive, but I would say I think investors should wait for some time before investing in Infosys for long term. I would say wait for some time. Maybe 1 or 2 quarters we should give some time to stabilize, find its foot for the next innings, right? So I'm sure the tech sector will bounce back, but it'll take a little while, I would say, before flourishing.
For the IT sector, at least for now, would not be a right time to be looking at that one. Let me quickly go across to Raja and get his few picks and stock picks that he's taking at this point. What are the ones that are on his radar, especially given the market circumstances that we are dealing with currently?
Yeah, so like you rightly said, given the market circumstance, I'm just playing for the bounce, and I would like to initiate first of all, buy in Cipla at around 1140 with a stop loss at 1120 for a target of 1160 and 1175. And I would like to initiate a sell in Bharti at around 905 with a stop at 917 for a target of 890.
Right. So those are the two stocks that he's suggested, Bharti as well as Cipla, that is on Raja's radar. Well, thank you so much, gentlemen, for giving us your time this morning. That's all the time we have on this edition of Morning Trade. Well, coming up next is Opening Bell.
Yeah, just give me a clue.